Good morning, Richard.
Good morning.
Good morning.
Good morning.
Richard, based on the topic we just covered during this session this morning, I would ask you what's the view of the at the EMEA level, what our clients are saying, having been part of several CX or forum and discussing about this topic indeed, about innovation, digitalization, open banking.
Okay, yeah, thanks, Mando. Yeah, you're right. I mean, I run a number of CXO forums where we get head of risk and head of technology on calls with other customers of ours, and we've done that for right the way through the pandemic, and I think it's been very clear that there's been a shift in attitude towards customer experience in particular. So, you know, I think it's been fairly consistent across most markets that customers have had to move online, and a lot more customers are a lot more comfortable with operating online, and therefore they get a lot more choosy, shall we say, about the providers that they use. That they expect a lot more because they're used to interacting with the likes of Amazon and those sort of organizations in an online way, and they expect a similar level of service. And lots of organizations probably had digitization on their strategic roadmap pre-pandemic. Most organizations had some form of digitization project going on. Some organizations had appointed a head of technology, head of transformation, or a head of digitization. But what we saw was a lot of those projects suddenly became priority number one. And some organizations managed to switch quite easily. Some organizations were found to be a little bit behind everybody else and had to move very quickly. And many organizations are still in that transition phase. But a lot of that is driven by customer experience and the need to be able to offer a high level of positive customer experience in those digital interactions. And I think this is borne down in pretty basic research that we saw a long time before the pandemic, that if you can get your customer experience right, then that drives a good long-term relationship. So, for example, we were seeing in collections already, those days of when you measured the effectiveness on your collections department on the dollars collected for the dollars spent. Those days were starting to be the days of the past anyway. We were already starting to see collections departments looking at customer experience and looking at those customers who've been positively recovered from the collections process. If they've been treated well, if the NPS of those customers is positive, they become a long-term advocate of that organization. They become very loyal. They're likely to buy additional products and services. So that change was already happening, but certainly the pandemic has accelerated that. And I've had conversations with customers about ethical collections and how you can approach the collection activity with a customer without putting them in undue stress. Additional stress because of everything that's going on with the pandemic, and trying to understand whether their job loss is temporary or it's likely to be permanent, and how you can restructure the loan and give them payment holidays and those types of things. All what has been termed ethical collections, and it's all driven by the need to drive a better customer experience.
Okay, thank you, Richard. Related to, you just mentioned that, of course, in the last year, there's been several changes in customer behavior, right? But I guess not only customer behavior, but also on the credit profile, okay? And the way the ability to repay their debt, both for individuals and companies. The point is that how now data need to be adapted. Data and the way we use those data need to be adapted to this new environment.
Yeah, so it's an interesting one because I've worked for Experian for 20 years, and in that 20-year period, I've talked to lots of organisations about the power of the data that they already have. So, that idea that if you own the current account or you own the credit card, you have lots and lots of transactional data. And that transactional data can be used to profile the spending activity of the customer, and you can derive a significant amount of insight into that customer. Not many organizations actually did it. And one of the reasons they didn't do it, or two of the reasons they didn't do it, was one, it was quite complicated to manage that volume of data. And two, the technology wasn't really up to the job of analyzing all of those huge volumes of data and making sense of it. And in the last sort of 3 or 4 years, a number of things have happened. The first is the technology has come on a long, long way. So we now have, big data environments, the Hadoops and H2Os of that, and ever increasing power in those types of environments. And at the same time, the advancement in analytics, so advanced analytics, machine learning, AI, they've gone from being a little bit out there to being mainstream. And lots of organizations are now looking at their models and looking at how they can use AI and machine learning. I was talking to one organization who was telling me that something like 70% of their models now have some form of machine learning and AI. That was almost inconceivable maybe 3 or 4 years ago, that organizations would consider using an AI algorithm to make decisions on customers. But it's the only way you can process that volume of data. And then, of course, the third thing that's happened is that there is a need to be able to explain that to the regulator. And the regulator, Experian has developed its explainability model within its PowerCurve strategy management suite, and that is really needed to be able to explain to the customer and to the regulator about how you've made those decisions. So over the last 2 or 3 years, those things have sort of come together to enable what was in theory possible before to be in practice absolutely possible. So the categorization of transactional data, we do that for many customers today. It's I wouldn't say it's easy, but it's becoming a lot easier than it was. And building models and models that learn and adapt around that data is becoming a lot more straightforward. But that's great for the retail banks, for those banks that own the banking relationship and the credit card relationship and things like that. The other significant change, of course, has been the open banking legislation, which makes that data accessible to those financial services organisations who just get one payment per month for the loan or the leasing contract that they might have. They now suddenly have access to all of that data as well. And if you can get the customer to share that data, we can help you to get a huge amount of insight, infinitely more insight into that customer than you ever had before. And it's relatively straightforward. It's available as a service. It's available to plug into your existing decision engines. And so that transition over the last couple of years, maybe 3 years in particular, I think is going to transform the way the credit industry uses data. And of course, we now have a lot more data, structured and unstructured data. You've got data that you can get from social media sites that will become more acceptable and more usable within the credit industry as organizations and credit committees and regulators get used to the fact that we are using machine learning and AI, and we have the ability to be able to explain how those models are predicting risk and how that transitions into decisions on customers.
Great, really interesting, Richard. And now looking ahead about the future. So you already mentioned this something that will happen in terms of data, but what are the main trends you expect in the credit industry in the future? What are the other things that most probably going to, change the way we are going to work in the following years?
Yeah, so I think that move to the more mainstream use of machine learning and AI. So we have lots of organisations who have data science teams. They have data scientists working on these And one of the things that I hear quite a lot is that developing models is quite hard, but becoming more commonplace. Actually implementing them is relatively hard work. And I think there's a stat that something like 60% of all machine learning models that are developed never get implemented. And those that do get implemented only get implemented in a sort of pilot and never become part of the operational makeup of the organisation. I think that will change as organisations get more used to the management of the data, because the big issue is the operationalization of the data capture in real time, so that you can use that data in the decisioning, and as I've already mentioned, the explainability to the regulator. I think that will become more mainstream. So lots of organisations, and particularly those organisations that are more innovative, will get an advantage by using that data. The data that's available will become a lot more. We see that over the last few years that there's been an explosion of data. And data in itself has no value. It's just a data pool, a data lake, a data ocean, whatever you want to call it. Actually using that data is relatively hard. What you need is the analytics to make sense of the data, to provide you with insight. And I've already talked about the machine learning and AI, the advanced analytics that's becoming more commonplace. But you then need to be able to put that analytics into some sort of decision, and you need to be able to operationalize that, which I think is one of the key challenges that organizations are facing today. But once you've put that structure in place, the availability of the data in the data lake that you are using, that data lake is only going to get bigger. There's only going to be more data. You're probably going to end up using more unstructured data. We already have products where we use Google search data to predict risk, and we're finding that those models are relatively good in terms of differentiating good from bad. To a certain extent, they are sometimes nearly as good as bureau data in the SME space in particular. So I think a lot more of that type of unstructured data will get used. But I think the big change that's coming is on the technology side. So the move to cloud is almost overnight. We've seen organizations whose IT strategy had been pretty much fixed for the previous 20 years, which was build it ourselves, host it ourselves, and on-premise deliveries of big software projects. Almost overnight, that's completely gone out of the window because of the pandemic, because organizations realize that makes it difficult for them to respond and react to big strategic change. And most organizations that I talk to now have a cloud strategy. Some organizations have switched to a cloud-only strategy, and that makes the access to data a little bit more difficult in some ways, but it makes the turning on of services, the adoption of new services a little bit easier, relatively easy to how it was before. So I think that will be a big change that organizations, and particularly people in the credit risk industry, will have to get used to, because that will open up some opportunities. It'll also create some difficulties in terms of regulation and where the data is stored and those types of things. So they're the things that I think will be driving the agenda on these types of conferences going forward.
Great, Richard. Really good way to close our session today, with a lot of insight about main trends in the credit history, what's happening in EMEA. So thanks again for your participation.
You're very welcome, and hope everybody's had a great conference, and hope to speak to you all soon.
Thank you.
Thanks. Bye-bye.